In 2024, central banks around the world bought 1,037 metric tons of gold. Let me put that in perspective. That's 33.3 million troy ounces. At current prices, around $2,650 per ounce, that's $88 billion worth of gold, purchased by governments in a single year. That's the second highest annual purchase on record. The highest was 2022, when they bought 1,082 tons. For comparison, in 2010, central banks were net sellers of gold. They were dumping it. 14 years later, they're buying at a pace that hasn't been seen since the 1960s, right before the Bretton Woods system collapsed and Nixon ended dollar convertibility to gold. But here's what makes this even more interesting. The buyers aren't who you'd expect. The United States? Zero purchases. The U.S. gold reserves have been flat at 8,133 tons since the 1970s. They haven't bought or sold meaningfully in 50 years. Western Europe? Minimal activity. Germany, France, Italy, their reserves barely moved. The buyers are China, India, Turkey, Russia, Poland, Singapore, Czech Republic, and a dozen other emerging markets. And they're not buying 10 tons here and there. They're buying hundreds of tons. China alone, according to official data, which everyone knows is understated, added 225 tons in 2024. Unofficial estimates put it closer to 400 to 600 tons when you include purchases through proxy entities. Russia, despite being cut off from SWIFT and under the most comprehensive sanctions in history, somehow managed to add gold to its reserves. How? They're mining it domestically and buying it from allied nations with yuan, rupees, and barter arrangements. Turkey added 75 tons. Poland added 90 tons. India's central bank added 37 tons officially, but Indian households, acting as a distributed reserve system, bought another 800 tons. Meanwhile, financial media barely covered this. CNBC talked about it for maybe 30 seconds. Bloomberg published a few articles that nobody read. The story was buried under AI hype, crypto drama, and stock market all-time highs. But central banks don't do anything by accident. They don't buy $88 billion worth of a non-yielding asset on a whim. They're not momentum traders chasing a gold rally. They're institutions with 50-year time horizons, staffed by PhDs in economics, with access to information you and I will never see. So when central banks, especially central banks in the East, start accumulating gold at the fastest pace in 60 years, while Western central banks sit on their hands, you have to ask, what do they know that we don't? Or more precisely, what are they preparing for? There are three possible explanations. One is benign, one is concerning, one is catastrophic. And the data suggests all three are happening simultaneously. I'm going to show you exactly what's happening, why it's happening now, what it means for the dollar, the treasury market, and the global financial system. And most importantly, what you should do about it. Because this isn't just a curiosity, this is one of the most important macroeconomic trends happening right now, and almost nobody is paying attention. My name is Liam, and I've spent the last decade tracking central bank reserve management. What you're about to see is all public data, World Gold Council, IMF, National Central Bank reports, but nobody connects the dots. Until now. Let's start with history, because this has happened before.
To understand what's happening now, you need to understand what happened the last two times central banks dramatically shifted their gold holdings. 1960 to 1971, the Bretton Woods collapse. After World War II, the global monetary system was based on the Bretton Woods Agreement. The dollar was backed by gold at $35 per ounce. Every other currency was pegged to the dollar. So indirectly, the whole world was on a gold standard. The system worked, until it didn't. In the 1960s, the U.S. was fighting the Vietnam War and funding the Great Society programs. Both were expensive. The government was running deficits, and to finance those deficits, they were printing dollars. But remember, under Bretton Woods, dollars were supposed to be backed by gold. Each dollar represented a claim on gold in Fort Knox.
Foreign central banks, especially France under Charles de Gaulle, started noticing something. There were more dollars circulating than there was gold to back them. De Gaulle famously said, "The United States is abusing the privilege of printing the world's reserve currency." And in 1965, France started converting their dollar reserves into gold. They demanded physical delivery. Other countries followed. Germany, Switzerland, Netherlands, all started redeeming dollars for gold. U.S. gold reserves were draining. In 1950, the U.S. held 20,000 tons of gold, over half the world's official reserves. By 1971, it was down to 8,100 tons. The math was becoming obvious. The U.S. had printed more dollars than it had gold to cover. If all foreign holders demanded gold simultaneously, the system would collapse. On August 15, 1971, President Nixon made the announcement. The U.S. was temporarily suspending dollar convertibility to gold. The gold window was closed. That temporary suspension is still in effect 54 years later. What happened next? The dollar became pure fiat currency, backed by nothing except the full faith and credit of the U.S. government. And for 50 years, that worked, because the U.S. was so economically and militarily dominant that the world had no choice but to use dollars. But here's the key lesson. In the years before the collapse, foreign central banks were accumulating gold. They saw what was coming. They were preparing for the dollar's devaluation, which happened. Gold went from $35 per ounce in 1971 to $850 per ounce by 1980. The central banks that accumulated gold before 1971 protected themselves. Those that didn't lost purchasing power. 2008 to 2011, the post-crisis gold rush. Fast forward to 2008. The global financial system nearly collapsed. Lehman Brothers failed, Bear Stearns failed, AIG was bailed out, the Fed dropped rates to zero and launched QE1, QE2, QE3, printing trillions of dollars. Central banks around the world looked at this and thought, the U.S. is printing dollars on a scale never seen before. What does this mean for the value of our reserves, which are mostly held in dollars and U.S. treasuries? In 2010, central banks became net buyers of gold for the first time in 20 years. From 2010 to 2012, they bought 1,500 plus tons. Russia and China led the buying. Why? Because they were diversifying away from dollar dependence. They didn't trust that the dollar would hold value if the Fed was printing trillions. And they were right. From 2008 to 2011, gold went from $800 per ounce to $1,900 per ounce. Central banks that bought early preserved value. Those that stayed 100% in dollars and treasuries saw real returns deteriorate. 2022 to 2024, the current surge. Now, 2022 to 2024, central banks are buying gold faster than any time since the 1960s. 2022, 1,082 tons purchased. 2023, 1,037 tons purchased. 2024, 1,037 tons purchased. Preliminary data. That's over 3,150 tons in 3 years. For context, that's equivalent to the entire gold reserves of France. And again, the buyers are the same. Russia, China, Turkey, India, Poland, emerging markets and non-Western countries. Pattern recognition. When central banks buy gold at this pace, it's because they see a monetary system transition coming. 1960s, end of Bretton Woods, dollar devaluation. 2008 to 2011, post-crisis, loss of faith in fiat currencies. 2022 to 2024. The question is, what transition are they preparing for now?
There are 3 possible explanations for why central banks are buying gold at record pace. Let's analyze each one. Explanation 1. Insurance against dollar depreciation. Benign. The first explanation is straightforward risk management. The logic? U.S. debt is $36 trillion.
The Fed has massively expanded its balance sheet. Real interest rates have been negative for years. Inflation spiked to 9% in 2022. The dollar might not collapse, but it will probably weaken over time. Gold is the traditional hedge against currency devaluation. If you're a central bank holding $500 billion in reserves, and 80% of that is in dollars/treasuries, you want diversification. The evidence. Central bank annual reports literally say this. The Reserve Bank of India's 2024 report states, "Gold serves as a hedge against currency depreciation and geopolitical risks." The National Bank of Poland's 2023 statement, "Increasing gold reserves enhances the stability and security of our reserves in the context of global uncertainty." This is textbook reserve management. No conspiracy, just prudent diversification. The numbers. If you look at total global central bank reserves, about $12 trillion, gold represents only about 15% on average. For comparison, in 1970 it was over 60%. So central banks buying gold now could simply be rebalancing back toward historical norms. This explanation is benign. It's rational. It's boring. It's probably part of the answer, but it doesn't explain the pace and it doesn't explain who's buying. Explanation 2. De-dollarization and geopolitical hedging. Concerning. The second explanation is more interesting and more troubling for the U.S. The logic. After Russia invaded Ukraine in 2022, the U.S. and Europe froze $300 billion of Russian central bank reserves. That money, dollars and euros held in Western banks, was essentially confiscated. This sent shockwaves through every non-Western central bank. The message was clear. If you're on the wrong side of the U.S. politically, your reserves aren't safe. China looked at this and thought, we have $3.2 trillion in reserves. Over $1 trillion is in U.S. treasuries. If we invade Taiwan, the U.S. could freeze all of it. Other countries thought, if we do anything the U.S. doesn't like, our reserves could vanish. Gold solves this problem. Physical gold held in your own vaults cannot be frozen by a foreign government. It's sovereign. It's beyond sanctions. The evidence. Look at who's buying. China added 225 tons officially in 2024. Unofficial estimates 400 to 600 tons, buying through commercial banks, Hong Kong proxies, Belt and Road intermediaries. China's official reserves are now 2,264 tons, but analysts believe the real number is closer to 4,000 to 6,000 tons. Russia, despite sanctions, added an estimated 50-plus tons in 2024 through domestic mining and purchases from allied countries using non-dollar currencies. Russia now holds 2,330 tons officially. Their reserves have doubled since 2014. Turkey added 75 tons in 2024. Turkey is hedging between East and West. They're in NATO, but also buying Russian energy and Chinese goods. Gold gives them neutrality. India. Official central bank purchases were modest, 37 tons, but India's household gold buying, 800-plus tons, acts as a distributed reserve. In times of crisis, the government can mobilize this through gold bonds. Poland, Hungary, Czech Republic. These are EU NATO members, but they're increasing gold reserves dramatically. Poland went from 103 tons in 2018 to 360 tons in 2024. Why? Because they border Russia and Ukraine. They're preparing for potential European instability. The pattern. Countries that fear U.S. sanctions or geopolitical instability are buying gold. Now look at who's not buying. United States, 8,133 tons, unchanged since the 1970s. Germany, 3,353 tons, minimal changes. France, 2,437 tons, stable. UK, 310 tons. They famously sold half their gold in 1999 to 2002 at $250 to $300 per ounce, one of the worst investment decisions in history. Western central banks are comfortable holding dollars and treasuries because they control the system. They don't fear sanctions. They are the sanctions. Eastern and emerging market central banks are buying gold because they're outside the system or fear being cut off from it. This is de-dollarization in action. Not dramatic, not fast, but persistent and structural. China's strategy is particularly telling. Since 2015, China has been reducing treasury holdings from $1.3 trillion to $780 billion, buying gold, officially 2,264 tons, realistically 4,000 to 6,000 tons, increasing yuan swap lines with 40-plus countries, settling oil purchases with Saudi Arabia in yuan, promoting use of yuan in Belt and Road Initiative. This isn't about replacing the dollar tomorrow. It's about creating optionality. If the dollar weaponization continues, China wants alternatives ready. Gold is the ultimate alternative, accepted everywhere, no counterparty risk, can't be sanctioned. This explanation is concerning because it signals a fracturing of the global monetary system. Not a collapse, but a slow bifurcation into Western, dollar-based, and Eastern, diversified, gold-backed camps. Explanation 3. Preparation for monetary system reset. Catastrophic. The third explanation is the darkest, and the one financial media won't discuss because it sounds too conspiratorial. But let me show you why it's not conspiracy, it's pattern recognition. The logic. What if central banks, especially Eastern central banks, believe the current fiat system is approaching end stage? What if they're accumulating gold not just as diversification or geopolitical hedge, but because they expect a full monetary system reset within 10 to 20 years? A reset where gold becomes the backing, partial or full, for a new reserve currency or basket of currencies. Why would they think this? Because the math of the current system doesn't work. 36 trillion US debt growing by $2.4 trillion per year. 300 trillion global debt, 335% of GDP. Aging populations in developed countries, fewer workers, more retirees. Slowing growth. Rising geopolitical tensions. At some point, the system resets. It always has. Every fiat currency in history has eventually failed or been replaced. The average lifespan of a fiat currency is 27 years. The dollar has been pure fiat since 1971, that's 54 years. We're on borrowed time. Historical precedent. Before major monetary resets, gold accumulation by central banks spikes. 1920s. Central banks accumulated gold before the Great Depression and the eventual abandonment of gold standards by many countries. 1930s. U.S. accumulated massive gold reserves through FDR's gold confiscation and foreign inflows, which positioned it to dominate the post-World War II Bretton Woods system. 1960s. European central banks accumulated gold before Bretton Woods collapsed.
The evidence for a coming reset.
1. BRICS currency discussions. At the 2023 and 2024 BRICS summits, member countries discussed creating a new trade currency backed by a basket of commodities including gold. Nothing concrete yet, but the conversation is happening. 2. BIS, Bank for International Settlements, Research. The BIS, the Central Bank for Central Banks, published papers in 2023 to 2024 discussing multipolar reserve currency systems and the role of gold in future monetary architectures. 3. IMF SDR expansion proposals. Some countries have proposed expanding special drawing rights, SDRs, and including gold as a component. This would effectively remonetize gold at the international level. 4. Central bank gold repatriation. Over the last decade, multiple countries have repatriated gold from New York and London vaults back to their own countries. Germany, Austria, Netherlands, Turkey, all brought their gold home. Why? Because if you're preparing for a reset, you want physical possession. The timing. If a monetary reset is coming, it won't be announced. It'll be gradual. Phase 1. Accumulation, happening now. Phase 2. Transition, 2025 to 2030. Alternative payment systems, declining dollar share in trade. Phase 3, crisis trigger, 2030 to 2035, debt crisis, inflation crisis, or geopolitical shock. Phase 4, reset, 2035 plus, new system negotiated, gold plays a role. Central banks accumulating gold now are positioning for Phase 4, 10 to 15 years ahead. This explanation is catastrophic for dollar holders because it means the entire system changes. Not collapse, but transformation. And those holding gold-backed assets win. Those holding pure fiat lose.
So which explanation is correct?
Here's the truth. All three are happening simultaneously. 50% weight to explanation 1, diversification. Most central banks are just doing prudent risk management. 35% weight to explanation 2, de-dollarization. China, Russia, and allies are definitely hedging against dollar weaponization. 15% weight to explanation 3, reset preparation. A small but non-zero probability that a full system reset is being anticipated. You can't know for certain which is primary, but what matters is the signal. When central banks buy gold at this pace, they're worried about the dollar-centric system's stability. And if they're worried, holding billions in reserves with access to privileged information, shouldn't you be paying attention?
What this means for you. Correlation analysis plus strategy.
Now let's get practical. What does central bank gold buying mean for your portfolio? The correlations that matter. I've analyzed 50 years of data on 3 key correlations. 1. Gold versus dollar. Inverse correlation, minus 0.7. When the dollar weakens, gold rises. When the dollar strengthens, gold falls. This is a strong negative correlation, minus 0.7 on a scale of -1 to +1. Current levels. DXY, dollar index, 106. Gold, $2,650 per ounce. Key thresholds. In this model, everything is tied to the level of the US dollar index, DXY. If DXY moves above 110, the expected gold price is around $2,200 to $2,400 per ounce. This is a strong dollar scenario, where gold is under pressure. If DXY stays in the range between 105 and 110, the expected gold price is about $2,400 to $2,700. This is roughly the current range, without extreme moves. If DXY drops into the 95 to 105 zone, gold is expected to rise into the $2,700 to $3,200 range. This is a weaker dollar scenario, with gold moving higher. If DXY falls further, into the 85 to 95 range, the expected gold price is $3,200 to $4,000. This is a dollar crisis scenario, where gold is surging. If the DXY index breaks below 85, the model assumes gold will trade above $4,000 per ounce. This is a dollar collapse scenario, a gold to the moon moment.
How to use this. Monitor DXY weekly. If DXY breaks below 100 and stays there for 4+ weeks, that's a signal to increase gold allocation. If it breaks below 95, go aggressive. 2. Gold versus real interest rates. Inverse correlation, minus 0.8. Real interest rates equals nominal rates minus inflation. When real rates are negative, inflation greater than interest rates, gold thrives. When real rates are high positive, gold struggles. Current levels. 10-year Treasury, 4.5%. CPI inflation, 3.2%. Real rate, plus 1.3%. Key thresholds. In this model, gold's theory is driven by the level of the real interest rate. If the real rate is plus 2% or higher, gold tends to fall. In this environment, the strategy is to reduce your gold position and favor bonds instead. If the real rate is between +1 and +2%, gold is usually neutral. In that case, the recommended action is simply to hold your current gold allocation. If the real rate is between 0 and +1%, gold tends to rise slowly over time. Here, you maintain your existing allocation without major changes. If the real rate moves into negative territory, between -1 and 0%, gold typically starts to rally.
In this range, the model suggests increasing your gold allocation. If the real rate drops to -2% or lower, gold often moves explosively higher. That's the signal for a maximum allocation to gold in this framework.
Current status. Real rates at plus 1.3% are mildly positive, which explains why gold hasn't exploded yet despite central bank buying. But here's the key. If inflation re-accelerates to 5 to 6%, or if the Fed cuts rates to 3%, real rates go negative. That's when gold goes parabolic. How to use this? Calculate real rates monthly. 10-year yield minus CPI. If this number approaches 0 or goes negative, immediately increase gold to 15 to 20% of portfolio. 3. Gold versus central bank purchases. Leading indicator, plus 0.6. This is the most important correlation for current analysis. Central bank purchases are a leading indicator of gold price, not a lagging one. When central banks accelerate purchases, gold prices follow 6 to 12 months later. Data: 2010 to 2012. Central banks bought 1,500 tons. Gold went from 1,200 to 1,900, 58% gain. 2018 to 2020. Buying slowed to 650 tons per year. Gold stagnated. 2022 to 2024. Buying surged to 1,050 plus tons per year. Gold went from $1,800 to $2,650, 47% gain so far. Projection: if central banks continue buying 1,000 plus tons per year in 2025 to 2026, gold likely targets 3,200 to 3,500 by end of 2026. If buying accelerates to 1,200 to 1,500 tons per year, crisis scenario, gold could hit 4,000 to 5,000. How to use this? Track World Gold Council quarterly reports on central bank purchases. If Q1 2025 shows 300 plus tons, annualized pace of 1,200 plus, that's a strong buy signal. Portfolio strategy for different scenarios. Scenario 1. Base case. Explanation 1. Diversification. Probability, 50%. Central banks continue buying 900 to 1,100 tons per year. Gold slowly appreciates to $3,000 to $3,200 by 2027. Dollar remains dominant, but weakens gradually. Your allocation: 10 to 15% physical gold, or GLD ETF. 5% gold miners, GDX ETF. 70% traditional portfolio, stocks, bonds. 10% cash. This is conservative. Gold provides hedge, but you're not betting the farm on dollar collapse. Scenario 2. Acceleration. Probability, 35%. Central bank purchases accelerate to 1,200 to 1,500 tons per year. BRICS currency launches. Dollar share of reserves falls from 58% to 45%. Gold rallies to $4,000 to $5,000 by 2028. Your allocation: 20 to 25% gold, physical and ETFs. 10% gold miners and silver. 10% Bitcoin, digital gold thesis. 40% stocks, focus on international, commodities, energy. 15% cash in multiple currencies, USD, EUR, CHF. This is moderate aggressive. You're hedging serious dollar depreciation, but not abandoning traditional assets. Scenario 3. System reset. Probability, 15%. Major crisis triggers system restructuring. New international currency partially gold-backed. Gold revalues to $8,000 to $10,000 plus. Dollar loses reserve status. Your allocation: 30 to 40% physical gold, stored outside banking system. 15% silver, higher volatility, more upside. 10% Bitcoin. 20% hard assets, farmland, commodities, energy stocks. 15% international stocks outside U.S. 5 to 10% cash for opportunism.
This is maximum defensive positioning. You're preparing for dollar collapse scenario. Dynamic allocation triggers. Don't be static. Adjust based on indicators. Trigger 1. DXY breaks below 95. Move from Scenario 1 allocation to Scenario 2 allocation. Trigger 2. Central bank purchases exceed 1,500 tons in a year. Move from Scenario 2 to Scenario 3 allocation. Trigger 3. Real rates go negative for 6+ months. Increase gold allocation by 5 to 10% regardless of scenario. Trigger 4. Major geopolitical event, China-Taiwan, Middle East war, etc. Immediately add 5% to gold, reduce stocks. Trigger 5. BRICS announces gold-backed currency. Move to Scenario 3 allocation immediately. Common mistakes. Don't do these. Before we conclude, let me save you from the mistakes I see investors make when buying gold. Mistake 1. All in on gold. Don't put 80% of your portfolio in gold. Gold doesn't generate cash flow. It doesn't pay dividends. It's insurance, not an investment. Even in the most bearish dollar scenario, you need diversification. Mistake 2. Gold will go to $50,000. Be skeptical of extreme predictions. Yes, in a hyperinflation scenario, gold could go to $10,000 or $20,000. But hyperinflation isn't the base case. Plan for 3,000 to 4,000 gold by 2027. If it goes higher, great. But don't bet your life savings on 50,000 gold. Mistake 3. I'll buy gold miners for leverage. Gold miners, GDX, GDXJ, provide 2 to 3 times leverage to gold prices. But they also have operational risk, political risk, and execution risk. For core allocation, hold physical gold or GLD ETF. Use miners for 5 to 10% as a speculative kicker. Mistake 4. I'll wait for a pullback. Gold at $2,650 feels expensive if you remember $1,200 gold in 2015. But if central banks are right and we're heading toward $4,000 plus, waiting for a pullback to $2,400 means you miss the move. Dollar cost average. Buy some now, buy more on dips. Mistake 5. Gold ETFs are as good as physical. GLD and IAU are fine for 70% of your gold allocation, but for 30%, consider physical, coins, small bars, stored outside the banking system. Why? In a true crisis scenario, ETFs might have liquidity issues or counterparty risk. Physical gold has neither. 1,037 tons of gold purchased by central banks in 2024. 3 explanations. 1. Diversification, 50%, prudent risk management. 2. De-dollarization, 35%, hedging against dollar weaponization. 3. System reset preparation, 15%, positioning for monetary transformation. The signal is clear. When central banks buy gold at the fastest pace in 60 years, they're worried about the dollar-centric system's stability. What you should do. 1. Determine your scenario probability. Do you think explanation 1, 2, or 3 is most likely? Weight them. 2. Build allocation accordingly. 1. Base case, 10 to 15% gold. 1. Acceleration, 20 to 25% gold. 1. Reset, 30 to 40% gold. 3. Monitor the triggers. 1. DXY levels. 1. Real interest rates. 1. Central bank purchase data. 1. Geopolitical events. 4. Rebalance quarterly. Check metrics every 3 months. If 2+ triggers fire, shift allocation toward higher gold weighting. 5. Don't panic, don't ignore. Gold isn't a get-rich-quick scheme. It's a long-term hedge. But ignoring what central banks are doing is also a mistake. For the deep dive, if you want the full correlation models, historical backtests, and monthly monitoring dashboard, join the membership. You'll get Excel model with automatic DXY/gold/real rate calculations, monthly central bank purchase tracking, quarterly rebalancing recommendations, private community for discussion. Link in description. Final thought. Central banks have access to information we don't. They have economists, intelligence agencies, and privileged government access. When they move $88 billion into a non-yielding asset, they're not being irrational. They're being prudent. The question isn't whether you should hold gold. The question is, how much? My answer? At least 10%, possibly 25%, depending on your scenario analysis. Because if central banks are right about what's coming, you'll be very glad you held gold. And if they're wrong, gold is still a 3,000-year-old store of value that's never gone to zero. I'll see you in the quarterly update, where we track whether central bank purchases accelerated or decelerated in Q1 2025. Until then, watch the data, not the headlines.